My name is Kathleen Engel, and I'm a law professor here at Cleveland Marshall College of Law. As Council Member Westbrook pointed out, also the school that Tim Russert graduated from. Before I begin, I want to just disclose that I'm on Senator Obama's Housing Policy Committee, but what I'm saying today doesn't reflect the policies of the senator or the committee. My research looks at an array of issues related to predatory lending, and that includes the different forces that led to the emergence of predatory lending and the role that Wall Street has played in financing abusive lending. One of the questions that I've sought to answer in my research is how could it be that so many bad loans were made without them raising anyone's eyebrows? And the answer to that question lies in an industry expression: a rolling loan gathers no loss. Like rolling stones, loans and pieces of loans have rolled from brokers to lenders to investment banks with significant greasing from the rating agencies. Each of these entities has collected fees as the loans passed through their doors, but none of them retained any significant risk of loss, at least not until the last year. Because the lenders and the investment banks were able to pass the risk of these loans onto investors through securitization, they didn't screen loans to see if there were problems in them. They didn't look for evidence of fraud or whether people could actually afford to pay the loan. As long as they could get investment-grade ratings from the rating agencies, the mortgage-backed securities would sell, and the rating agencies had every incentive to give good ratings because the lenders and the investment banks were the ones that gave them business. Bad ratings would be bad for the rating agency's business. Investors, greedy for profits that could be made from subprime loans, purchased securities backed by these loans without adequately assessing the risks associated with them. And borrowers, who typically didn't understand the risks because the brokers and lenders' representations were that the loans were affordable and that the loans could be refinanced if the borrowers were ultimately unable to make their monthly payments. In addition to steal a word from Scott Adams of Dilbert fame, the lenders and brokers created a confuseopoly, which made it very difficult for the borrowers to determine exactly what they were getting into. The bottom line is that the entities that could ensure that the loans were properly underwritten failed to screen the loans because they didn't bear the risk of loss or were blindly focused on the returns they were getting. And the borrowers who had the most to lose, couldn't easily see the risks associated with the loans. So the question that we were asked to address today was what can be done now? What is important for the candidates to be thinking about as we go into the election? We need to think about solutions from two perspectives. The first is how to prevent this harm in the future, and the second is what can be done today to help to curtail the defaults and foreclosures. Turning first to prevention. The financial services market is incredibly complicated. Interventions are needed at every level of the market. It's critical that we adopt a national anti-predatory lending law that holds the owners of loans, the people who purchase the loans, responsible for any abuses at the loan origination. This will create incentives for the investment banks and other entities involved in securitization to assess the quality of loans before they roll them out the door. We also need to subject non-depository institutions to federal regulation. Right now, non-depository institutions are subject to only minimal regulation, which is part of the reason this industry has run rampant. We need stricter laws governing appraisers and brokers. They're the Wild West in this industry. And the government needs to reform the rating agencies in ways that prevent them from being captured by the investment banks as they are now. I like to use the analogy that having the rating agencies rate these loan pools is like having students grade their own papers. In terms of the current crisis, the government needs to help borrowers get out from under these abusive loans. This means cramming down the amount of loans to the market value of the property and refinancing borrowers into affordable fixed-rate loans. Of course, investors' returns will be reduced, but we could give them a choice. Village. Funding such a proposal would be tough, But the alternative, the current stalemate, where their modifications are not happening, borrowers are losing homes, and investors are losing returns, is even worse. And if we learn in the coming weeks and months that there was some untoward activity among the various companies involved with securitization, these companies may have good reason to help the government in funding a refinancing program, especially if it means they could avoid governmental sanctions. Lastly, we need to think seriously about programs that convert homeowners to renters. Some people shouldn't have bought homes in the first place, and we are victims of our own societal goals of increased homeownership. And these people need help making that transition. If they can't make their mortgage payments, they can't make their deposits on a rental unit. In sum, in thinking about preventing harm in the future and remedying the injuries wrought by subprime lending, the government should turn to the entities that made the money and tried to shed the risk. Thank you very much.